So last week we talked about adjusting entries. Today we will finalize the accounting cycle. We will talk about closing entries. We learn how to prepare an adjusted trial balance. And as you can see now, the material builds up on the previous chapter always. So for example, with chapter 1, we learned the accounting equation. In chapter 2, we learned how to record a transaction using debits and credits, right? And how to journalize it and post it. And that one depended on the accounting equation. As an advice, if you're trying to do the homework or solve any problems, etc., follow the same, like for example with chapter 2, homework, follow the same process that we did when we were explaining that in class. Start by analyzing the event itself. See what actually happened in plain English. Like, for example, you purchase supplies on account. What does this mean in plain English? That means you bought supplies, you didn't pay. So you know that at that time, supplies are affected and accounts payable. And then you start analyzing what happened to each one of them. Supplies have increased. And accounts payable, the liability has increased. Basically, you have more debts now. So supplies increased, accounts payable also increased. How do you record an increase to supplies, which is an asset account? You debit. So you debit supplies. And how do you record an increase to liability, such as accounts payable? You credit. So you know that the journal entry is debit to supplies, credit to accounts payable. If you follow this process, it takes you like 10-15 seconds more than just jumping to the end and just writing the journal entry. However, you will be more or less, in my opinion, you will make sure that you got the answer correctly. I will personally spend more time and guarantee that I have the correct answer than trying to do it faster and not get the answer correct. Any questions? Okay. So for today we will be talking about closing entries, about finalizing, basically about the accounting cycle, etc. So we will complete the accounting cycle. We'll learn what the accounting cycle is. We'll learn how to do correcting entries. We touched on that, I think it was in chapter 2. We'll learn how to use a worksheet. Now, what's a worksheet? What's a worksheet? A worksheet basically is like a spreadsheet. Usually companies use it as a spreadsheet. It has different columns. Each column has certain information. So those columns, we have to follow a certain procedure to complete the worksheet, and we will be doing that. Okay? Companies, this is not a mandatory step. A lot of companies do that because it makes it easier for them to prepare financial statements directly from here. When companies use a worksheet, they will prepare the financial statements directly from the worksheet. This usually happens before preparing the adjusting entries for those companies who actually do it. Okay? So, you have to understand that this is not a permanent accounting record. What do we mean by that? This is not a journal. This is not a ledger. This is simply a working tool, a tool that is used to prepare to prepare the financial statements, etc. And you can also use it to prepare the adjusted trial balance. This is how it looks like. So you have first the trial balance. We have the columns for the trial balance. And by the way, as you can see, for each set, think of it as a set of columns. For each set of columns, we have debit and credit columns. So for example, for trial balance, we have both debits and credits. The same thing applies to adjustments. Adjustments are not the adjusting entry. This is what you will be doing when you're doing the adjusting entry. That's not an adjusting entry. You're not recording it. This is not a journal. You're simply trying to say, okay, so this is how this this adjustment will affect the trial balance. And that will lead us to the adjusted trial balance. Once we have the adjusted trial balances, so we have all the balances for all the accounts, we simply move them to the financial statement columns. As you can see, we have the income statement columns. This is where we will have what? Revenues and expenses. And then we have the balance sheet. As you can see, we do not include here the retained earnings statement. Okay? They immediately included, basically they directly included on the balance sheet, and usually the retained earnings statement is prepared from this information. You find that there's no need to have two columns where you would simply have one information. In this case, the change in information will be very simple. It will be just one, it will be simply one account. Okay? So dividends will actually be included under balance sheets. We'll see each one of them separately. So this is the trial balance that we did last week. This is exactly the trial balance that we did last week and the week before. Okay? We had all these accounts. Now, after that, you start making the adjustments. You remember those adjustments here? Those were the adjusting entries. Remember, the worksheet is done before that. So what happens here is that we had those events. The company recognized the supplies expense to actually record the supplies used in the month of October. You guys remember that? Okay, so this one is an adjustment to which accounts? Yes. The first one is an adjustment to which account? So we have supplies expense and supplies. Supplies expense and the supplies account, right? So this is where you will actually, and we debited supplies expense, we credited supplies, right? So now let's go back to this one. In the adjustment, we will have to put a debit next to supplies expense. Do you have supplies expense here? And how are we going to deal with it? Sorry? Okay, so the adjustment, but where are we going to record the adjustment to supplies expense? There is no supplies expense here. In the list, we do not have a supplies expense. Yes? You add it at the bottom here. You add it here. Okay? So in the exam, you will be actually given one like this with a couple of adjustments, and then you will be asked to complete the worksheet, and you will be asked questions based on the completed worksheet. I'm telling you in advance, part of the exam. How cool is that? You know for sure that you will get a worksheet. So practice and learn how to prepare a worksheet, and most likely you'll get all the answers correct. Remember that if you get it wrong, you have we'll have 5 questions or 10 questions, I can't remember. Haven't decided yet, to be honest. But in this case, those questions will be all related to this one. So you'll get basically 0 if you don't finish the worksheet. But I'm telling you up front, this will be a question or several questions on the exam using this one. That's the same number. Now, so I forgot to mention something with the exam. Do not think later on, do not tell me that the questions in the exam were different from the sample exam, because they will be different from the sample exam. I will never give the same exam twice. So do not think that this is the same one. Now, so here, we started with a trial balance. You do notice here that we have double. Who can tell me what this double line means? Yes?
That's the final sum.
Yes, so that's the final sum. Thank you so much. That's the final sum of this column. When you get to this point, it means that this is the sum, and this is the double line means that this is the ending balance. Think of it this way. ending balance of the sum, the total, etc. Now, once you have those adjustments, this is what we call keying. So the adjustment keys are this. We have to make an adjustment for supplies that were used in the month of October. And as you can see, there are letters here, A, B, C, D. This one is basically to indicate or to link every two adjustments. So for example, we said that the first one was to adjust for supplies used. We know that we need to debit supplies expense, credit supplies. Supplies expense was not in the original trial balance, so we add it here. We add it after the totals. So this is the total, was the original. This was the trial balance, we add it afterwards. You just list them one after the other. We have supplies expense. This is not a well-formatted financial statement. You understand that? So it's not like a financial statement where you have to do it in a certain order and a certain format. Here you just use like those. So for example, you listed them in the order they appear. So for you have supplies expense. We needed to debit that, so we included the adjustments. Now we're dealing with what we're doing here is we're actually doing the adjustments. So here, this is the part that we're looking at. This is the second step. The first step. So step one was to actually enter the information from the trial balance. On the trial balance, you see this one here, we enter the debit balances under the debit column, the credit balances under the credit column. Now we have to deal with adjustments. We'll look at each one of them separately. The first one, so this is the first one, supplies used. We know that supplies used is actually 15, as you can see here, it was a debit of 1,500 to supplies expense. So because supplies expense was not included in the original in the trial balance, we add it under the totals, and we have it here. This is debt. What account was credited? Supplies. So you add it under the credit side of supplies. In this case, you start also doing them one by one. As you can see, there's an A at the beginning. This A simply means that this is the same transaction. This is the same adjusting entry. So the debit to supplies expense should be linked. It should be linked to supplies account, to the credit and supplies account. We move on to the second one. We have insurance expired. This is to record the insurance that has expired. What did we do before? We debited insurance expense, we credited prepaid insurance, right? For the value of $50. So in this case, what do we have? We have B. Sorry, insurance expense. It was not included in the original balances, so what do? We add it here. And then the credit to prepaid insurance. Now prepaid insurance was already there. So as you can see, it was simply added to the credit side of that account. Do you guys understand what we're doing here, or do you have any issues with that? Okay. So once we have prepared all these adjustments, those are not adjusted balances. Those are the adjustments. So what do we do next? We actually calculate. We actually look at. Sorry. We actually look at what we have on. What we actually have is we have the trial balance, we have the adjustments. What we need to do is actually to calculate the adjusted trial balance. How do we do that? You add the debit side and the debit side, and then you subtract the credit side and the credit side. So you add those and you subtract those. Or you do it the other way around. If it is a credit account, so for example, if it's a liability, you add the credits, you subtract debits. There's another way of doing that if you want. You can again do a T account. So in this case, if you want a T account, you have cash, and nothing happened to cash. Let's do supplies. What was the trial balance?
2,500.
2,500, debit or credit?
Debit.
Debit. So it was a debit of 2,500. What was the adjustment? Credit, 1,500. So 1,500. What's the new balance? Sorry? 1,000, debit or credit? So this is the new balance. Where do we put it? On the because it's on the debit side, we include it here on the debit side. That's the same one. So let's do that for the unearned revenue. The original account, basically the trial balance was. So this unearned revenue. What was the trial balance? Yes. 1,200 on the credit side. And then what did we do? We debited 400. What's the new balance? 800 on the credit side. This is the 800. We move it to the credit side. This is the part that we're doing right now. This is step 3. So step 1 was to simply copy the information from trial balance to the worksheet. Step 2 was to key in those adjustments. They were not still adjusting entries. They were not made into the journal as adjusting entries. This is done before. You just knew that you had to adjust for supplies expense and for unearned revenue, etc. We made those adjustments here in the second step. The third step is to calculate the adjusted trial balance. As you can see, it's not complicated. You just look at those accounts and then you count the number, right? So if you want to do it in the other way here, we had credit 1,200 minus 400 plus 0. It was 800. So the same thing. In any way you want. You just do it in the way that you feel comfortable. But in the same way, you have debits minus credits. If the account is debit, and if the account has a normal credit balance, it will be credit minus debt. Okay? Once you do that for all the accounts, now what do we have? What do we have? Yes. So, you were saying? The adjusted trial balance. We have the adjusted trial balance. This is the updated information, and as you can remember from last week, we said that this is the information that the companies will use to prepare the financial statements. Okay? Now, still, this is just a working tool. We have not posted anything. We did not journalize it. We did not make the journal. We did not journalize the journal. Basically, the adjusting entries. We did not post them to the ledger. Simply a working tool to calculate this information. And to make sure that at the end, we still have those balances that are correct. Okay? The next step would be to copy. So this is the same information. As you can see, the balance in cash was 15,200. The balance in accounts receivable was 200. We go back here. We have the same information here. This is accounts receivable. But as you can see, they are not listed in the same format as the official adjusted trial balance. Because this one is, as you remember, it was listed in the same order that they appear in the ledger. Whereas in the worksheet, it's not the case. In the worksheet, we have accounts that we did not find in the trial balance, so we added them at the bottom. It does not mean that they will still show up at the bottom when it goes to the adjusted trial balance. So the next step is to copy this information to the various income statements. That's easy. What accounts go on the income statement? Revenues and expenses, right? So whenever you see revenue or expense, copy the same information to this column here. So look, the first one, cash, no. Supplies, no. Equipment, etc. Unearned revenue, no. Dividends, no. Service revenue, yes. So we copy service revenue. You copy the adjusted balance. So here what we're copying is adjusted balances. So we take the adjusted balance, we copy it. Because it was on the credit side, we copy it to the credit side. We move on. Salaries and wages expense. The adjusted balance was 5,200. On the debit side, we copy it to the debit side of the income statement. We just copy revenues and expenses. And if they were on the credit side, you move them to the you will copy them to the credit column. If they were on the debit column, you copy them to the debit column of the income statement section of the worksheet. Okay? This is easy, right? And next, what do? We have the balance sheet. We do the same thing with the balance sheet. You have the balance sheet accounts, which are assets, liabilities, and stockholders' equity. In this case, we have the assets like cash, supplies, etc. We have the contra assets. Accumulated depreciation will be included as well. This is accumulated depreciation here. We copy the whole thing. In addition to those accounts, we also copy dividends. So this is the change between the balance sheet itself and the balance sheet information on the worksheet. But now that we have all this information, we can actually prepare the income statement, right? From the income statement column, we can prepare retained earnings. Can we prepare retained earnings from this information? What do you need to prepare the retained earnings statement? You need first the retained earnings beginning balance, right? Now this one, what's the beginning balance of retained earnings? You guys see the account? Sorry? No, before adding the net income, what was the beginning balance of retained earnings? Can you see it in the on the account under one of the account titles on the left side? When you don't see an account, what does it mean? The balance is 0. You don't see the account, the balance is 0. So in this case, the balance for retained earnings, the beginning balance was 0. When does that happen? Only in one case, usually. When it's the first case, when it's the first year for the company. Because the next year, the company will have a balance in retained earnings. But when the company just started, they didn't have any retained earnings from previous year because there was no previous year. That's the first year. Remember that you have to calculate retained earnings from the net income. But if the company has just started, they have no net income from previous year. As a result, retained earnings will be 0. That's the beginning balance. How do you calculate the ending balance? You have the retained earnings beginning balance, right? Then you add net income, subtract dividend, that would give you the ending balance of retained earnings. Can we do that here? Do we have the information, the necessary information? Do we have the retained earnings beginning balance? Yes, we do. Do we have the net income or net loss? Yes, we do. Although it is, at this point, it's still not directly found here, right? Actually, the last step would be to calculate net income. Net income is the difference between revenues and expenses. It should balance revenues and expenses. Now, net income The difference between the two, as you can see, is added when it is a net income, not a net loss. When it's a net income, the net income amount is added on the debit side. Why is that? 2? No, it's not asset. Net income is not an asset. Net income is basically, it's not actually an account. Net income is a computed amount. Now this is the only way to balance debit and credit. And remember, we must balance debit and credit. What are we saying here? Basically what we're saying here in this case, saying that remember that net income is equal to revenues minus expenses, right? So the value of revenues or net income plus expenses should be equal to revenues. Am I correct? Basically what we have here, 10,600 must be equal to 7,740 plus net income. This is why it goes on the same side as the expenses. Okay? If it were a net loss, it would be a negative amount, so it will go on the credit side. If we were to add net income on the credit side, we would have a big difference. It would be like 10,600 plus 2,860 on the credit side, and on the debit side we would have 7,740. That's not correct. You have to keep in mind that all circumstances, this one and this one must be equal. In the same way as this one and this one must be equal. Okay? Now, we have, this is the net income. 2,860. This is the amount that will go, it was here on the debit side, it goes on the credit side of the balance sheet. We will learn later on how we transfer that information there. But this is basically the difference between, again, between assets and liabilities and stockholders' equity. This is the only thing, the only piece of information that was missing to calculate retained earnings and to basically balance the accounting equation. If you have total assets or total debits, not necessarily total assets, total debits, minus total credits, this amount will be the difference. So this is the amount that will be different between the two columns. It's the same amount as net income. We have completed the worksheet. You do that correctly, you're guaranteed the answers to those questions. Because the answer to those questions will be like, for example, what's the adjusted balance for equipment and supplies? You have to actually add them together, something like that. What was the balance under the balance sheet column? What's the balance of common stock? You need to know this information. And just as a reminder, common stock does not change unless the company issues new stocks. Okay, or buy back their own stocks, which we will learn later on. But for now, unless they tell you that new stocks were issued, that means that there was no change to common stock. But let's say that in this case, we had some, during the year, we had common stocks issued, then it will be added. You remember from chapter 1, the last few slides from chapter 1, we have this equation, stockholders' equity, ending balance is equal to stockholders' equity, beginning balance, plus common stock, plus revenues, minus expenses, minus dividends. Remember that one. We'll be using that a lot to solve those problems. Anyone has a question on this one? Okay. Okay. income will be shown on the income statement debit columns, and it will also show on the credit column of the balance sheet. It says what we said here, those are the ones here. It's this one here and here. Okay? Now we got 91%, so I'll be generous this time and give you a smiley face. That's a weird one. Wait.
I look so depressed.
Okay, that's much better. Now, how do we prepare financial statements from the worksheet? You can see already that this is kind of similar to what we did last week when we used the adjusted trial balance to prepare financial statements, right? That's even easier here because you already have the columns separated. So we have the columns that are the income statement columns is already there. We use that information. We have revenues and expenses and their balances. And then for balance sheet, we have the same information. Okay? For retained earnings, again we have the retained earnings beginning balance. If it were already on the trial balance, it will be there. If it's not, then it means it was zero. Then we know that we have the net income and we have the dividend amount, so we can calculate retained earnings. This is, as you can see, the net income here has to be the same one that we have on the worksheet. We just listed the same information, but here, as you can see, it's more organized. Can you see that? So there it was all over the place. We had service revenues, and then we had expenses, and then we had revenues again, etc. So it was all over the place. It could be basically like a little bit messy. Whereas in this case, it's much more organized. That's the formal one. As you remember, we always have the first line will be the name of the company, then the title of the statement, the name of the statement, and the accounting period of that statement. Okay? That's simple. The double line under the 2,860 means that this was the total amount. Retained earnings. So the retained earnings statement, again, we started with 0, and this is simply because usually it's the first year. So no previous retained earnings. And it's, how do you know that? It's not showing on the trial balance. We add net income. If we had net loss, what would we do? Subtract it. So at that time, we would have less net loss, less dividends. Okay? Bless you. In this case, we have add net income and less dividends. We got this one. Where did we get this one from? The balance sheet columns, right? Remember that? This is from the balance sheet column, from here. So the ones that we used for retained earnings was this one and dividends, which is, I think, this one. Both of them are from the balance sheet columns. Okay? So we have the balance sheet columns. And we use them to calculate retained earnings. Now this is the new balance. Again, we have the double line. This is the new balance. This is the ending balance of retained earnings. Where will that go? Yes. The balance sheet under which section? Stockholders' equity section. Remember, retained earnings is stockholders' equity account. So, but again, now the balance sheet uses the same information that we found, that we had in the balance sheet accounts, in the balance sheet columns of the worksheet. However, now they are split, or they are organized by assets, and then we have liabilities and stockholders' equity. Okay? So for assets, you always start with basically cash, and then accounts receivable, etc. So we have cash, and basically the other assets. We have the other parts. Once again, we have here the double line, this is the total. When we are doing liabilities, you see here this one, total liabilities. Although it's total liability, but this is not the end of this section, because we have not included stockholders' equity. Now just to let you know, we could have had all the information in one statement, right? Instead of calculating net income, and then going from net income to retained earnings, and then from net retained earnings to the balance sheet. We could have had all this information in one statement. What would the problem be?
Super long.
It would be like too long. It would be like 100 feet long with all these expenses and all the. But now we have sample of the expenses. Companies may have much, much more than that. Imagine having all this information in one statement, while good luck fitting that on one page. I mean, who can read? It's very difficult. It's already too difficult to fit this small part on one page. Okay? So, plus, when you split it, you're looking at it from different perspectives. When you look at the balance sheet, you're looking at a snapshot, and on that day, this is what we had. When you look at it from an income statement, for example, you're looking at how profitable the company was. When you look at retained earnings, you will know basically what part of the net income was given back to you as shareholder in the form of dividends, and what part remained in the business. Okay? So all this information is useful and makes it more organized and easier to understand. Now, we have here, this is the balance that we calculated in this one. You remember, 2,360. And we included it here. Again, we don't have dividends, we don't have revenues, we don't have expenses. All this information is summarized in this amount, which is 2,360. So we have liabilities. We list all the liabilities and the balances based on that, on the two columns from the balance sheet. So if you did, can you see now how if you do the worksheet correctly, you can simply copy paste all this information, it will be very easy. This is why a lot of companies prefer to use it or like to use it. Now remember, we were saying that the worksheet is done before making those adjusting entries, before entering those adjusting entries in the journal. Right? Those were basically, it's simply a tool to use it. They did it in advance before actually doing the adjusting entries. Now, how difficult is to go from the worksheet to the adjusting entries? It's very easy. And why is that? Let's go back here. So for example, in this one, what would be the first journal entry? The first adjusting entry? You look at A. So we look at A here, and we simply have a debit to supplies expense and a credit to supplies, right? That's the journal entry. Now you take B. B was a debit to insurance expense and a credit to prepaid insurance. That's the second adjusting entry. So that's not a difficult thing to do. You just go from here and you prepare the adjusting entries and you journalize them in the same way that we did last week. But this is basically done, so you will not have to reinvent the wheel and do it again. Any questions? Am I going too fast or are you guys okay? Okay, nice. So Susan Elby is preparing a worksheet. Explain to Susan how she should extend the following adjusted trial balance accounts to the financial statements column of the worksheet. So basically, when you have cash, the cash has what balance? Or where do you find the balance of cash? So now remember, when you want to extend the information from the worksheet to the financial statements columns, that will be from the adjusted trial balance columns and you have to move them to the income statement columns or the balance sheet column. So for example, cash. Where do you find cash? On the debit side, right? On the debit side of the adjusted trial balance. Now, where does it go? Cash, does it go on the income statement columns or on the balance sheet? Balance sheet. So we know that we are going to transfer or extend cash balance from the adjusted trial balance to the balance sheet. Does it go on the balance on the debit side or the credit column? Basically, the debit column or the credit column? The debit column. So you take it to the balance sheet on the debit column. Accumulated depreciation. Remember, if it's not revenue or expenses, you immediately take it to the balance sheet columns. Is it a revenue or expense? No, it's not, right? What's accumulated depreciation? A contra asset account. So where does it go? On the balance sheet. We know that it's going on the balance sheet. Because it's a contra asset, it's the opposite side of the asset. So it is on the credit side. So we take it to the credit side, the credit column. Accounts payable. That's a liability. Liabilities go to the balance sheet and on the credit column. Dividends. We don't have retained earnings columns on the worksheet. Remember, this is new, we're still working on the worksheet. Lauren, you're right. It will go eventually on the retained earnings statement. But on which column? Would it be under the income statement or the balance sheet? Balance sheet, not income statement. Income statement is strictly revenues and expenses. Everything else will go to the balance sheet columns. Okay? So this will go to the balance sheet columns. Dividends will go on the debit side or the credit side? Debit side. Okay? Now service revenue. Revenue, immediately, income statement. So it goes on the income statement columns. Which column? Debit or credit?
Credit.
Revenues, they go on the credit side, the credits. What about salaries and wages expense? Also, income statement and on the debit side. Any questions? Any questions about that? Now, companies at the end of every year, usually, companies, they close the books. What do we mean by closing the books? Sorry? They actually, basically they want to turn a new leaf, okay? So what they want to do is, they want to start with a new, fresh balance for the new year. What does that affect, basically? Which accounts do you think that this will affect? When you think of a company that has cash balance, does the company want to basically start with a new balance every year? They want to keep whatever they have in their bank. They don't want to make it zero. But when the company thinks of net income, they want to mix net income or revenues, simply revenues. They want to keep mix revenues from 2014 and 2015. No. They won't say, okay, so we are done with the revenues from 2014. Now, we started with a new zero, we earned zero in 2015. Remember that the income, that revenues and expenses, they are used to prepare the income statement, which is for a specific period of time. It's for, let's say, a fiscal year, right? So for a fiscal year, basically what you're saying is that this is how much we made in 2014. So you cannot carry with you anything that you earned in 2013. 2013 was for 2013. 2014 is for 2014. So by the end of 2014, the company closes their books. Okay? They close their books to start with a fresh balance for revenues and expenses. You can say that, for example, oh, we had a lot of expenses in 2014, and you include rent from 2013. That doesn't make any sense. Expenses of 2014 should be expenses from 2014 only. So basically, at the end of 2013, you should start with a zero balance for expenses and zero balance for revenues. Do you guys understand this concept? This concept is what we call closing the books. Okay? So it's like, think of it in a way like a bad breakup. You want to basically forget about the whole thing and start with a new year resolution, something like that, and then you want to start with a new life in this year. The company will do the same thing, but they do it with money. So their love is for money, not for another person. Good for investors, right? Now, there are temporary accounts and permanent accounts. Temporary accounts are those accounts that the company will want to start with a new balance. Those are the stuff that basically it's like with a bad breakup, you want to burn everything that the other person, that your ex had, right? You want to burn their pictures and their whatever clothes they left, etc. This is what you're going to do here. The company will be burning all the previous information. They will only keep the permanent accounts. They will transfer the information from revenues and expenses and from dividends, because those are for a specific period of time. So dividends and revenues and expenses from 2014, they have to die with 2014. The balances will have to be zero by the end of 2014. Where does this information go? It will be transferred to a specific account in the permanent accounts. What are these? So, yes.
It's going to become retained earnings.
Exactly. Thank you so much. Retained earnings. This is the information that we use to prepare retained earnings. Right? Revenues, expenses, and dividends. This is the information, basically it tells you how much from the profits of this year, of 2014, the company kept in the business. That will be closed. Those accounts will be closed to retained earnings. So this is when we talk about closing the books. We basically have basically 4 entries. Every company will make 4 entries at the end of every year. They don't do that at the end of every month. They do it at the end of every year when they want to start with a new thing, because they don't want to mix revenues and expenses and dividends paid in 2014 with those from 2013. Now we will see how we are going to close those accounts. So when companies prepare those closing entries, they will close revenues and expenses and dividends to retained earnings. However, remember, retained earnings is a permanent account, right? This will still remain in the company. The company will still have a certain amount of money that is retained in the business after basically even with the new year. It's not going to go zero. It's not like you'll start with no money to the basically owed to the shareholders. They still own some money. This is retained earnings, right? So we have retained earnings. The problem with retained earnings is that it is a permanent account. So if we close revenues and expenses to that permanent account, you will have a lot of entries, not unnecessary entries. So what companies do is actually they close retained earnings, or they close revenues and expenses. They introduce a new account that is called income summary. Income summary is basically the same amount as net income, but this is the actual account that is used. Okay? Now, so companies, what they do is they close revenues to income summary, and they close expenses to income summary. This is basically as if you are calculating net income. Okay? The amount that will show on on the income summary, this will be the amount that is the same as the net income. And this is the number that will be closed to retained earnings. So in this case, how many entries do you make on the retained earnings account? 1 from income summary. And then there's a second one that you will make from dividends. Now let's do something here. Let's say that individual revenue, so here you do it with individual revenue accounts and individual expense accounts. Let's say that on the revenues we had, the balance on the revenues was, I don't know, $5,000. Usually it is a credit account, right? Revenues are credit, have normal credit balance. So we had $5,000 in revenues. If you want it to become 0, what do you do?
You debit 5,000.
Exactly. So what you need to do in this case would be to debit $5,000. The new balance will be 0. However, can you just simply debit the account and not do anything else? There is always the other side of the transaction. So you will debit revenues and you credit income summary. Basically what we did here was simply transferring this information from here to this one. This is what we mean by closing revenues. You guys understand now what we mean by closing revenues? And as you can see, dividend is separate. Dividend is separate from expenses and revenues because dividend is not an expense. You have to keep that in mind. It's not involved in calculating the net income. This is why we do not close dividends to income summary. It's not related. Those are the 4 closing entries that the companies will have to make at the end of every year. Okay? You have 4 of them. That's not too hard. You close revenues to income summary. You close expenses to income summary. And then the number in income summary, you close it to retained earnings, and you close dividends to retained earnings. So let's go back here. Let's say that here we have expenses for the value of $2,000. How do you close this one? Okay, so credit 2,000. If you credit 2,000, what do you need to do? You have to debit income summary 2,000. Now, what's the balance under income summary? What's the new balance under income summary?
3,000.
3,000, right? This is the new balance. Again, we want to close this account. This is a temporary account. And by the way, income summary is only used for closing entries. The whole year, the company, bless you, the company does not use that account. They only use it for closing entries. Now, if the company wants to close that account, what do? They have to, how do you make the balance 0? You debit it. So the closing entry will be a debit of 3,000 here, and we debited this one, so you credit retained earnings 3,000. So the idea here is that debits must always equal credits. If you debited an account, you must credit another account. This is why we don't talk about increase and decrease. We talk about debits and credits. So if we debited 3,000, you have to credit another account 3,000. Okay? In this case also, like for example, dividends. Let's say that we had a balance of dividends for $500. So the balance was 500. How do you make it 0? You credited 500. We credited an account 500, so you need to debit another account 500. So you debit 500. The ending balance for retained earnings is, this is the ending balance. And remember, this balance is a permanent, this is a permanent account. What does it mean? It will be simply, on the balance sheet, it will show that this is the balance of retained earnings. Okay? So the closing entries, as you can see here, we have service revenues. You start with revenues, you list all the revenues. So we have here revenues, service revenue was debited, and income summary was credited. Let's say that we also had sales revenue. You also include it here in the same entry. So you have one entry for all the revenues, one entry for all the expenses. You see all this information? If we were to simply directly close it to retained earnings, you would have had to add all this information, and usually it's much, much longer, to a permanent account. Do you need this information to be included in the permanent account? Do you need to see how every year you close each account separately to retained earnings? Companies do not need that information. So they still have the information in the form of closing entries. But on the permanent account, they don't need to look at all this. When they have the balance, they will simply see two entries. Those two entries are a closing of income summary, so this one and this one, closing of retained earnings. Again, there are four closing entries. You debit revenues, you credit income summary, you credit expenses, you debit income summary. So the first one would be to debit the revenues, credit income summary. The second closing entry would be to debit income summary, credit expenses. That will give you basically the balance and income statements, the balance of the net income. And then you close the income summary to retained earnings by debiting income summary if you had net income. If it were a net loss, you do it the other way around, you credit it. It's always the opposite of the balance that you have. Okay? Yes?
Could you say that one more time? So
Sure. Let's say that I'm going to go back to this example here. Let's say instead of this one, and instead of having this amount here for income summary. So income summary. We had 5,000, and here we had 2,000, right? From expenses. Let's say instead of 2,000, we had actually 8,000. What would the balance be? You have more expenses than revenue. So this is the net loss. It will be on the debit side. So you have here 3,000. How do you close this one?
you have to
Credit it. In this case, you will have to credit it 3,000. So this is in case of net loss. Once you credit this one, 3,000, you need to debit again. In this case, you will have to debit it to retained earnings. So you have to bring it here. So it will be the other way around. Okay? You always close an account. When you want to close an account, enter the same balance, the ending balance, on the opposite side of where the balance is. If it were on the credit side, debit that amount. If it is on the debit side, credit that amount. So in this case, first one, we debit revenues, we credit income summary. Second, closing entry, we debit income summary, we credit all the expenses, individual expenses. The third entry is where we debit income summary, credit retained earnings. This is in case of net income. In case of net loss, it will be the other way around. We will debit retained earnings, credit income summary. And the fourth one, and the last one, is where we close dividends to retained earnings by debiting retained earnings and crediting dividends. Any questions? Those are the four closing entries. You know those four, you know how to close the books. Okay? So basically, if you understand those four closing entries, you should be fine and you should be able to close those accounts. Now, posting those closing entries, this is how it is posted on each account. So for each account separately. In the previous one, we did it like on a summary basis. So here you have the balance for expense was 15,000, 1,500. Let's start with the revenues. The balance here was 10,600. This is one, as you can see one. So this is step one. This is where we close the revenue to income summary. And then we have the second one, which is the closed expenses, one by one, and the total was here. So this is a repetition of what we did. That was simply a summary of all the expenses. Here you have it individual expenses. Any questions? Okay. At the end, you have, when you get to the, when you do that, the ledger will only have, basically, will have the permanent accounts with balances. And as you can see, you have here closing entries. It shows the closing entries. This is an explanation to say why this change has happened. You have two, remember, you only have two that show up on the permanent account retained earnings. This is where we close income summary and dividends. And then you have all the temporary accounts, they have zero balances. So all temporary accounts, that is, all the expenses and all the revenues and dividend accounts will all have zero balances. This is why we call them the temporary accounts. Any questions about that? Now, companies prepare post-closing trial balance in the same way that we prepare the trial balance and the adjusted trial balance. This one will only include the permanent accounts. Okay? And why is that? Because all the temporary accounts, they have zero balances. So they will not show up on the closing, post-closing trial balance. Any questions? So here, for example, worksheet for Hancock company shows the following in the financial statement columns. We have dividends 15,000, common stock 42,000, and net income 18,000. Prepare the closing entries at December 31st. Here, we do not need to do the revenues and expenses because they gave us net income. So what are the closing entries? First, you need to close dividends, right? And so income summary is debited. First you close, income summary. So we have net income. You need to close. So what do? You debit income summary, you credit retained earnings. And then you close dividends by debiting retained earnings and crediting dividends. Any questions? This is as simple as that. Does not get any simpler. This is a summary of the accounting cycle that we learned. We start always by analyzing the business transaction. This is the economic event, a purchase of equipment, paying salaries. So you analyze the business transaction, we journalize the transaction, and then we post it to the ledger. Those are steps that the companies they might do on a daily basis. And then at the end of each month and quarter, etc., they will prepare a trial balance. They will journalize the adjustments. So they will journalize and post adjusting entries, and then they will prepare an adjusted trial balance. Once you're done with adjusted trial balance, you start preparing financial statements. That will be quarterly or or annual. Now, closing entries, which are steps 8 and 9, closing entries are done and post-closing are done only at the end of every year. Any questions?